Welcome to The Explainer. Today, we're jumping into the world of stock analysis, and, we're going to tear down that wall that makes it seem so complicated. If you've ever felt like investing is some exclusive club for experts only, you're going to want to stick around. We're about to give you the basic tools to look right past the hype and start feeling confident. So just picture it. You're scrolling online, you're seeing all these headlines about companies, stock prices are going through the roof, and it's just a lot. The biggest question, the one that's always there, is this. How in the world do you tell a genuinely solid company apart from something that's just a flash in the pan? Well, that's exactly what we're going to tackle today. And look, if you feel a little intimidated, you are definitely not alone. The whole language of investing, all the jargon, sometimes it feels like it's designed to be confusing, right? To keep people out. But our mission here is really simple. We just want to give you the tools to slice through all that noise so you can start asking the right questions. Okay, so how do you actually get in the game? Well, there are a few main ways to go. First, you've got the primary market. That's when you buy shares straight from the company itself, like when they first go public. Then there's the big one, the secondary market. Think of stock exchanges, where you buy from other investors. The thing is, that can take a lot of cash. But there's a third way, and this has been a total game changer for the small investor: unit trusts. It's where you and a bunch of other people pool your money together to buy a whole mix of shares. It's a great way to spread out your risk without needing a fortune to get started. So once you're ready to actually invest, you need a strategy, right? You need a map to guide you. And in the investing world, there are really two main maps that pretty much everyone follows: technical analysis and fundamental analysis. And these two approaches could not be more different. Technical analysts, they live by the idea that everything you could possibly need to know is already cooked into the share's price. So they stare at charts, they look for patterns, and they try to predict when to buy or sell. Fundamental analysts, though, they're more like financial detectives. They get out the magnifying glass and dig deep into a company's books, its leadership, its competition, all to figure out what a company is truly worth. And for the rest of this explainer, we're going to be focusing on their toolkit. All right, first up in our financial detective kit is a concept called gearing. This is one of the absolute most important ways to get a quick read on how much financial risk a company is actually carrying. Think of gearing as a company's riskometer. It just shows you the balance between money it borrowed, that's its debt, and money that's been invested by its owners, which is its equity. And why is this so critical? Because debt comes with a non-negotiable rule. You have to pay the interest, no matter how well or how poorly the business is doing. And you can see that trade-off right here. A company with low gearing, well, it has less debt. That makes it a much safer bet, especially if the economy gets rough. But a company with high gearing is carrying a lot more debt. It's riskier, for sure, because those interest payments have to be made. But, and this is the big but, if things go well, using more debt can actually supercharge the returns for shareholders. It's that classic risk versus reward balancing act. Okay, let's move on to our next tool. And trust me, this one is a heavyweight. If you really want to see past a simple share price and get a sense of a company's real value, you absolutely have to understand the price-to-earnings ratio, or what everyone just calls the PE ratio. But hang on, before we can talk PE, we have to quickly get our heads around its building block: earnings per share, or EPS. And this is really straightforward. You just take a company's total profit for the year and divide it by how many shares are out there. Simple. It tells you exactly how much profit is behind each and every individual share. And now the main event, the PE ratio. This formula takes that EPS we just figured out and it stacks it up against the current market price of the share. What it's really asking is a very simple question. For every 1 rand this company earns in profit, how many rands are investors willing to pay for it? This one little number is an incredibly powerful shortcut for comparing how expensive different companies really are. So let's make this real. Have a look at these two companies. At first glance, you might think, oh, company B is the better deal, right? It's cheaper. 40 rands is less than 50. But like we're about to see, the share price by itself, well, it doesn't tell you the whole story. In fact, it can be really, really misleading. Okay, let's follow the numbers. Both companies, they earn the exact same $50 million. But, and this is where it gets interesting, look at the number of shares. Company B has 3 times more shares out there than Company A. So when we do the math for earnings per share, Company A is earning a solid 5 rands per share, while Company B is only earning 1 rand and 67 cents. And that changes everything. The PE ratio for Company A is 10. That means investors are paying 10 rands for every 1 rand of profit. But for Company B, it's 24. So even though its share price is lower, Company B is way more expensive when you look at what it actually earns.
And that right there is the key. It's the whole point. Don't get fooled by the price tag on the shelf. The PE ratio is what lets you look under the hood and see what you are really paying for.
So what can this ratio tell you in a pinch? Well, generally speaking, a low PE might mean you found a bargain, a stock that's undervalued. A high PE could mean the stock is pretty pricey. But, and here's the catch, it could also mean that investors are super optimistic and they're expecting massive growth down the road. That's why context is key. You always want to compare a company's PE to its direct competitors in the same industry. Now, as powerful as these ratios are, let's be real for a second. This is a toolkit. It's not a crystal ball. And like any tool, they've got their limits, and you've got to know what they are. For starters, remember, these numbers are all based on the past, and what happened yesterday is no guarantee of what's going to happen tomorrow. Plus, different companies can use different accounting tricks, which can make a head-to-head comparison a little bit skewed. And of course, the tough truth is that sometimes numbers can be fudged. So think of ratios as the start of your homework, not the final answer. So what's the point of all this? Look, nobody expects you to become a financial wizard overnight. That's not the goal. The real goal is just to give you enough knowledge, enough confidence, to move past the flashy headlines and start asking smarter, better questions about where your hard-earned money is going. So let's bring it all back to those 2 maps we talked about at the beginning. A quote from our source material sums it up perfectly. Fundamental analysis tells you what to buy or sell, whereas technical analysis will indicate when to buy or sell. See? They're 2 different but equally important parts of the puzzle. Remember this number, 24? That was the PE ratio for Company B. Just one number, but it told a much, much bigger story about that company's value than its cheap 40 rand price tag ever could. It just goes to show you, if you know what to look for, a simple number can cut right through the hype. So we'll leave you with this final thought. It's true, financial ratios can't predict the future with 100% certainty. But in a world that's so full of noise and hype, can you really afford to try and invest without them? Thanks for joining The Explainer.